All right, let's dive right in. Today, we're going to break down a strategy that's a go-to move for a ton of options traders, but honestly, it can be pretty confusing for beginners. We're talking about rolling your options. You see, it's a super common way to manage a trade that's already in play, but doing it right, well, that can be the difference between a smart adjustment and a really costly mistake. So let's get into it.
So just imagine this for a second. You sold a covered call, and just your luck, the stock shoots up, and now your option is in the money. Or, hey, maybe you sold a cash-secured put, and the stock took a dive. Either way, you're kind of stuck at a fork in the road. Do you just let the option get assigned? Or is there another move you can make? This is exactly where the idea of rolling comes into the picture.
So what in the world is rolling? At its core, it's actually just one move with two parts. You're basically closing your current option and, in the very same breath, opening a brand new one. The only things you're really changing are the expiration date, the strike price, or maybe both. So try to think of it less like ending a trade and more like you're just extending it and tweaking the terms. Okay, so that brings us to the really big question, right? Why would you even bother doing this? I mean, what's the point of this extra step instead of just letting things play out? Let's break down the main reasons. See, rolling is a very active decision, and there are really four big reasons you might do it. First, and this is a common one, you want to avoid assignment. Say you sold that covered call. The stock rallied, but you know what? You've decided you really want to hold on to your shares. Second, you can collect more premium. You're essentially getting paid to keep the trade going. Third, it lets you adjust your position if maybe your opinion on the stock has changed. And finally, it's a great way to manage your risk, giving your trade a little more time or a better price to work out. So, you've decided you want to roll. Great, but how do you do it? It turns out there isn't just one way to go about it. Let's open up the playbook and look at the most common rolling strategies and figure out when each one makes the most sense. Okay, this breaks it all down for us. Let's walk through it. The simplest move is to just roll out. See here? You keep the very same strike price, but you just push the expiration date further into the future. The goal here is usually pretty simple. Just collect a bit more premium when you think the stock is going to hang out in a range. Next, for your calls, you can roll up. This means you're picking a higher strike price. You do this if the stock is climbing and you're trying to avoid having your shares called away. And if you're dealing with puts, it's the same idea, just flipped upside down. You'd be rolling down to a lower strike if the stock is falling. And finally, you've got the combo moves, roll up and out or roll down and out. This is where you're changing both the strike and the date, and that gives you the absolute most flexibility to manage your trade.
Theory is one thing, but let's make this feel real. We're going to walk through a simple, concrete example of rolling a covered call, just so you can see exactly how this whole thing works in the real world.
All right, so let's imagine you own shares of a stock, and you sold a covered call against them with a $27 strike price. Now, the stock has moved up to $27.50, which means your call is now in the money. You're at that classic fork in the road. On one hand, you could do nothing. Your shares would get sold or called away at $27, or you could roll the position. In this case, that means closing your $27 call and opening a new one, maybe at a $29 strike for a future date. And what's the goal? Well, you get to keep your shares and collect some more premium. So here's the crucial part. How does this actually happen? It's really two trades bundled into a single order. First, you have to buy to close that original $27 call you sold. That gets you out of your old contract. Then, at the exact same time, you sell to open the new $29 call with that later expiration. Most brokerage platforms actually have a specific roll button that handles both parts of this trade for you all at once. And what did you just accomplish? Well, you've successfully extended the life of your trade. You probably collected what's called a net credit, which is just a fancy way of saying the cash you got from selling the new option was more than what it cost to buy back the old one, so money in your pocket. And you've moved your strike price higher, giving your stock more room to climb before you're at risk of assignment again. Pretty cool, right? Now, this all sounds pretty great, I know. But, and this is a big but, we absolutely have to talk about the fine print. Rolling is a powerful tool for sure, but it is not some kind of risk-free magic wand. So let's talk about the costs, the risks, and the traps you really need to watch out for. First off, the hard costs. You've got to remember, a roll is actually two trades, closing one, opening another. So you're going to pay commissions and fees on both. You're also paying the bid-ask spread twice, which can slowly eat away at your profits. And here's the kicker. While the goal is usually to get a net credit, sometimes you might actually have to pay to roll. This is called a net debit, and that's a real cash cost that actually adds to the overall risk of your position. This right here, this might be the single most important idea to really let sink in. When you roll an option, you are not making the risk disappear. You're just kicking the can down the road. You're extending your timeline, sure, but that also means you're giving the stock more time to move against you. You are deferring the risk. You are not destroying it. And this leads us straight into these psychological traps our own brains set for us. It is so tempting to just keep rolling a losing trade to try and save it, which is basically just throwing good money after bad. Some people get stuck in this loop of overrolling, just pushing a bad trade further and further out, hoping for a miracle. The key is to stop and ask yourself this one simple question. If my account was totally flat today, would I enter this new position? If the answer is no, then it's probably better to just take the loss and move on. Okay, so knowing all those risks, how can we do this the smart way? Let's put together a simple checklist to help you make better rolling decisions, especially when you're just starting out. You know, just as important as knowing when to roll is knowing when not to. Sometimes the smartest move you can make is to do absolutely nothing. I mean, if the option expires worthless, hey, that's max profit. If you sold a covered call because you actually wanted to sell your stock at that price, well, then letting it get assigned is a win. And this is a big one. If rolling is going to cost you a big chunk of money, a large debit, it's often way better to just accept the smaller loss on the original trade and find a better opportunity. All right, let's wrap this up with some rapid-fire tips to keep in your back pocket. First, always, and I mean always, use limit orders for your rolls so you control the price. Second, stick to liquid options, the ones with tight bid-ask spreads, to keep your costs down. Third, and this is huge, have an exit plan before you even put the trade on in the first place. Keep good records. And please, 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 practice this on a paper trading account first. Get the hang of it without risking a single real dollar. So if there's just one thing you take away from all this, let it be this quote right here. Think of rolling as a flexible tool in your trading toolbox. It's there to help you adjust your risk, to manage a position, and to adapt to what the market is doing. It is not, and it should never be, a get-out-of-jail-free card for a trade that went south. Use it wisely, and it can be an incredibly effective part of your strategy.